Ladies and gentlemen, thanks for coming tonight. My name is Rob. I organize Idea to IPO. We've been doing events in Silicon Valley for many, many years. I want to highlight a few events that are coming up. Thursday, June 27th, How You Can Become a Silicon Valley Success, featuring Andre Guziak, angel investor. July 2nd, Human Decision Making for Entrepreneurs. That's in Sunnyvale. And further on down the line, July 25th, Venture Capital Panel, Investment and Latest Innovations in AI. So check out the details for those events and all of our events on our website, ideataipo.com. We launched on February 2nd, actually February 1st. February 2nd is my birthday. February 1st, 2010, with no members and no events on our calendar. At this stage, we have over 60,000 members among all our meetup groups in the Bay Area, and we've completed over 2,100 events. We're the most active, most prolific startup event organization in Silicon Valley, bar none.
Wow.
Thank you, I think. Our mission is to promote entrepreneurship, support entrepreneurs, build community, and provide value in the Silicon Valley startup ecosystem. To that end, we provide content that is practical, actionable, and relevant, stuff that you can actually use to succeed as entrepreneurs. And we believe in building community because Silicon Valley is an aspirational ecosystem. It attracts people from all over the world who come here to do great things. Who here is not originally from Silicon Valley? Who here was born and raised in Silicon Valley or the Bay Area? 2 natives. Let's hear it for the natives. Applause. Whether you were born and raised here or just arrived last night, it's important for us to provide multiple channels for you to meet people, build relationships, and grow your network. So in addition to our content-oriented events throughout the week, we also have some fun events. So tomorrow, actually, we have a TGIF mixer. It's at the Hyatt Regency Santa Clara. And the last Friday of the month, we're going to have a movie night. We'll see Avengers Infinity Wars, and that's at SVI Hub in Sunnyvale. So if you only have any plans for Friday night, check it out. It is important for us to provide value at each and every one of our events. So we make sure that our events are affordable, and if you cannot afford the cover charge for whatever reason, come talk to me and we can work something out. And at each and every one of our events, we make sure that we provide a delicious buffet meal. Is that a delicious buffet meal? Yes. All right. Well, thanks for all 5 of you that thought it was a delicious buffet meal. But anyway, I want to acknowledge the sponsor of that delicious buffet meal. That's Procopio Law Firm. So let's hear it for Procopio Law Firm. More importantly, though, at each and every one of our events, we want to make sure that we provide value for your time, which is your most valuable resource. We have many, many partners that help us do what we do. Law firms, venture capital firms, angel investor groups, incubators, accelerators, colleges, universities, lots of other players in Silicon Valley. So again, I'd like to acknowledge Procopio for hosting us at this beautiful venue and providing us with an awesome moderator. So let's hear it again for Procopio Law Firm. A few of our other partners are here tonight. I would like to have them come up and say a few words. Let's hear it for Angela in Life Stages. Applause.
Hi, everyone. My name is Angela Chen. I own an insurance agency called Life Stages Insurance and Financial Services. I help individuals and families with life and health insurance needs, especially with their job transitions. I also help small business owners with employee benefit plans, keyman insurance, and buy-sell agreements. Here's my flyer, and it's available on the table by the door, so feel free to pick one up. It's got my contact information, and thank you for your time.
All right, next we have Ali and Planner.ai. Applause.
Hi, my name is Ali from Planner.ai. We help teachers and coaches empower more students and clients. If you're a teacher or a coach, you have so many hours during the day during which you can reach out to your students or to your clients. So your service cannot grow beyond a limit. We want to change that. We can help you scale your individualized service to many students, to many clients, and that affordably. If you're a coach or teacher or an academy, please find me in the back. I would love to talk to you. We're looking for partners and early adopters. Thank you so much.
All right, next up we have Anna with First Republic Bank. Applause.
Good evening. Thank you for having me. My name is Anna Korn. I'm a relationship manager with First Republic Bank, and I'm part of the tech banking team. And we have a lot of partnerships and resources for business accounts and personal accounts. And I have some information out on the booth and really focus on relationships and how we can help partner. Thank you.
All right, next up we have Oli and Umit. Applause.
Hello, everybody. My name is Umit. We're actually serving our water in the lunchroom. So our project name is Uli. Basically, to put it short, it's like internet provider, but instead of modem, we install water filter, which gives unlimited access to fresh, healthy water whenever you need. No more plastic bottles and stuff like that. Thank you.
All right, last but not least, we have Kerfaz and No GPS. Applause.
Can I be here, near the lady? Yes. This is the article in today's Ars Technica, which says that a study finds that a GPS outage would cost $1 billion per day. In the same article, they have said that GPS has generated 1.4 trillion in economic benefit to private companies since 2000. If GPS fails, that's going to happen, that we will lose all that money and it will cost us $1 billion per day. And to maintain GPS, American taxpayers pay $2 million per day. And one satellite cost more than $1 billion. We have 24 satellites. I have come up with some system which gets rid of this GPS. We don't rely GPS on getting geolocation by putting intelligent neural network on the battery, on the walls, on the roads. And your road will tell you where you are, your wall will tell you where you are, your battery will tell you where. You don't need GPS satellite system. Thank you very much. Please come to my...
All right, here's the schedule for the rest of the evening. We're going to have an awesome fireside chat. Audience members, hold your questions at 8 p.m. We're going to open it up to audience questions, and we're going to have audience members come up here, and we're going to have you use the microphone to ask questions. I want to mention that tonight's event is going to be videotaped for our YouTube channel. Our local mission is to support entrepreneurs here in Silicon Valley. Our global mission, though, is to democratize entrepreneurship and innovation all around the world. So to that end, we maintain a robust YouTube channel, youtube.com/idea to IPO. Check it out. We have tons of videos, and we've documented and archived many, many of our events. And this rich, valuable content is available on demand, anytime, anywhere, totally free of charge. And our partner in this endeavor is Tim Jeggers of Jeggers Films, one of the top professional videographers in Silicon Valley. Let's hear it for Tim.
Thank you, Rob. Thank you, everybody. So I'm Tim. I've been doing video production for about a decade now. I've been managing Rob's YouTube channel for probably 3 or 4 years now. Can't believe that much time has gone by. I also do promotional stuff. I do property tours, real estate. I do some photography. I do weddings on the weekend if anyone's getting married. Or if you have any questions about anything video related or where you can find this content, feel free to reach out to me after the event. I'll be in the back. I'll be lingering around for a little while. And yeah, that's pretty much my whole thing, I guess. Thanks for coming and looking forward to a good talk.
Okay. Again, we're going to end the formal program at 8:30 p.m. roughly. Feel free to stick around and network, socialize, and connect. Finish off the food. As a courtesy to Procopio, we'd like to leave the building roughly at 9 p.m. So without further ado, I'm going to pass it off to our awesome moderator and our distinguished featured speaker guest. So let's hear it for Roger Rappaport and SC Moatti.
Excellent. Well, thanks, Rob, and thank you to everybody for coming in tonight. I realize we're on a real short fuse here, so we're going to try and be as succinct as possible. But I first wanted to give you a little background on Moatti Capital and also on SE. So Moatti Capital is a boutique venture capital firm that invests in companies building products that count. These are products that transform lives and create value at scale. Its unique model relies on a handpicked group of extremely successful Silicon Valley investors and proprietary access to one of the largest pools of product managers in the world, more than 200,000 of them, through one of the companies that Moatti SE has founded, which is Products That Count. What people are saying about Moatti Capital, Amplitude, which is one of Moatti Capital's portfolio companies, has said that Moatti Capital provides the best value for dollars invested. That's quite something from a portfolio company. And Business Insider has said that Moatti Capital has come up with a new way of doing venture capital. You can see all of this and a whole lot more at Moatti Capital's website. So a little bit about SC. She is the managing partner of Moatti Capital, founder of Products That Count. It's actually one of the largest communities of early adopters in the world. And previously, she built products that billions of people use at Facebook, Nokia, and Electronic Arts. Andrew Chen, one of Uber's top executives, has called SC a genius at making mobile products people love. And if that wasn't enough, there is actually more. SC is also the author of Mobilize, an award-winning bestseller and insider's guide to mobile success. So just before we get into the meat of it, my background, I was an entrepreneur for 10 years. Had a startup that when I exited, I didn't have the multi-generational wealth-creating exit that I thought I should have had. Went back to South Africa, bought a place on the beach, and came back for a few years. And then met my wife, who said I couldn't be a beach bum, so I figured go back to law school. It's an easy out, I have to get into the real world, and here I am today. So that's my background. I head up our emerging growth venture capital practice group at Procopio, deal with founders and companies from inception all the way through exit. So let's get into the meat of it. We're going to talk a little bit about entrepreneurship, then funding, and hopefully we'll have time to get to some questions about culture. So SE, maybe you can just give us a little bit of background and tell us how you got from Nokia, EA to Rendezvous, and then to Facebook and now Moatti Capital.
Yes, absolutely. And thanks for having me. Thanks for hosting. Thanks everyone for coming. So I grew up abroad. I grew up in Paris. And can you hear me? Yeah. I grew up in Paris, studied electrical engineering, came here 17 years ago to get my MBA, just nearby at Stanford, and then fell in love with California. Started building products and companies, so that's the Nokia, the Electronic Arts. After I sold my last company, which is Rendezvous, I spent a few years at Facebook, and then left Facebook because a publisher reached out, invited me to write a book on what makes a great product, which at the time, mobile was the new thing, so that's Mobilized. So I started writing this book out of my own experience and learnings. And then also I started interviewing my peers at the time, heads of products at various companies, Uber, Airbnb, and so on, and realized that everybody had a very interesting perspective on what makes a great product. So I was angel investing, and that's around that time that I started what became Products That Count. It started, frankly, as a dinner series at my house, so not in the garage, in the living room. And now it's it's a large network. We have more than 60 events a year around the world. We have about 3,000 pieces of content on our website, video, podcast, articles. And what's special about them is, first of all, the programming is all about what does it take to build a great product, which all of you, I'm sure, want to do for your companies. And it's also all been produced by chief product officer, VP product. So it's not a situation where you have some random person saying like, this is my opinion. It's somebody who's an expert, has a lot of responsibility, expertise, best practices. Lower.
Me, you're good.
I'm good. Okay. Okay. So these experts, they share their perspective on what makes a great product. And anyway, so as Products That Count was growing, my fellow angel investors at the time and myself, we started getting so much deal flow that we saw an opportunity. So as good entrepreneurs as we all are, we spun out a venture capital firm. And that's how Mighty Capital was born. And because of my product background, I started looking at the market of venture capital. And do we have any venture capitalists here? We don't, so I can say what I think. Which is, this industry is not differentiated, right? So when you work in technology, you have a product, you say, look, my product's really unique because it has this feature, and the other ones, they don't have this feature, so I really stand out, you should buy my product. But as a venture capitalist, you come and you say, look, you should really buy my product because, well, it's $1, right? Super differentiated. Not at all. And so the differentiation in venture capital is mostly extremely artificial. You'll hear something like, well, I only invest in late-stage deals. Why? Or I only invest in the US. Why? So we took a completely different approach and said, okay, we are going to be differentiating ourselves based on the value we bring to entrepreneurs. And that's how Products That Count really became a completely essential part of Mighty Capital, because we give our portfolio companies access to these 200,000 product managers. And so they're valuable for a number of reasons. Why they're valuable? Because they are very hard hires, right? So having access, exclusive access to this pool is super valuable when you're trying to grow a technology company. They're also valuable because a lot of them, they buy products, not just for themselves, gadgets and tech stuff, but also for their companies, right? SaaS, tools, product managers, VP product are very often either the primary buyer or a very strong influencer in the purchasing of technology products. And then they're also super valuable because they very often initiate M&A decisions. Oh, we have a portfolio approach, a strategy, and there's a gap. We're going to go find a company to fill that gap, right? So they're also providing an exit path for the companies that we invest in.
Are most of these folks in Silicon Valley, national, international?
They're everywhere. In fact, we're investing primarily in San Francisco Bay Area and New York because this is where the local network is strongest. But podcasts so I had growing a network is not a linear thing at all. So for the first 2 years, Products That Count is about 4 years old. For the first 2 years, it was sort of a small thing, right? And plus, my friend, I had just left Facebook. I was making zero money, and everybody was looking at me like, "Oh, you're growing a network, yeah." But then all of a sudden, right, there's some inflection curve. And all of a sudden, it becomes a global network. So this is a funny story. I had somebody come to an event in San Francisco, and thick accent, grabs my hand. "You are SC, and I thank you so much because I listen to your podcasts all the time." And this person was from Taiwan. I was totally blown away, right? So that's when it was a transition point.
Very cool. So just as you think about entrepreneurship, you've been doing this for a while. How have you seen entrepreneurship change over the last few years?
Yeah. I'll tell you, right now, entrepreneurs have a massive advantage over investors. If you're raising money, now is a great time. Not just because there's money everywhere, but because over the past 5 to 10 years, entrepreneurs have gotten very organized and savvy, right? So they join accelerator programs, they seek out advisors, and so on and so forth. So they're very organized. And if you look at, is there something equivalent for investors? Not at all. So you have a lot of people who, have been successful and say, okay, now I've been successful, I want to give back, I want to start investing. And because I've been a very successful executive or entrepreneur,
Therefore, right, I'm going to be a very successful investor. So just swap the word, entrepreneur with marketer or writer, and the word investor with engineer. Because I've been a very successful writer, I'm going to be a great engineer. And I'm going to, do that only once a month as an angel investor over dinner and a glass of wine. But I'm going to create amazing programs. Doesn't happen this way, right? So the investor network is not sophisticated at all, which means that as an entrepreneur, being sophisticated, you have a massive competitive advantage if you're trying to raise money. That's the first thing. The second thing is entrepreneurs have also become a lot more savvy and a lot more nimble, right? It costs a lot less money to start a company. There's all sorts of education on how to grow customer base, the growth hacking methodologies. Like it's been sort of codified, right? So I think it's been a very interesting journey from entrepreneur being kind of like magicians. It's almost like, if you watch Mad Men, you have the magicians of advertising. If you go to like a SEO expert, you have the entrepreneur of today, which is the kind of the marketing version of that.
Yeah, so they have great advantages. And as you look at the portfolio companies and great entrepreneurs that you meet, do you see any common mistakes that entrepreneurs are making at the early stage, maybe at the later stage as they're starting to scale? Anything that you can kind of point to and help folks avoid those mistakes?
Mythbusters, yes, absolutely. So I think we're still today, even though it's not popular to say that in Silicon Valley, but we're still sort of under the Facebook effect, right? So the Facebook effect is saying like, hey, you don't need to study, like just drop out and become an entrepreneur. Complete myth. If you actually compare apples to apples, you'll see something like, oh, there's a 15%, if I remember, of Fortune 500 companies or 400 CEOs, whatever, like are college dropouts. And of course, the Steve Jobs and so on. But if you actually compare apples to apples, right, people with a college degree who become entrepreneurs and people without a college degree who become an entrepreneur, right, that's apples to apples, then you're actually 6 times more likely to become successful if you have a college degree. So, the first myth is study hard. The second myth, which students don't like it when I tell them that, don't drop out, like study hard, but it's the reality. The second myth is build it and they will come. Right, that's another myth of the Facebook effect. Like, oh, I'm just a cool engineer and I'm going to build something really awesome and therefore I'm building a company. That's like a super, super big mistake. Delaying business model, delaying sales and marketing. Oh, I didn't raise quite enough funding. I'm going to cut sales and marketing. It's like, no, cut your engineering and develop your sales and marketing. It's really critical. And then the third myth that I think is also that Facebook effect is I don't want smart money. And so I'll give you a kind of a really sad example of that. There's a company that came to us about a year ago. And we've seen them before, we're interested. And the guy goes through his updates and, we have more traction and customer this and team that. And then at the very end, like the last 2-3 minutes, oh, and I got to tell you something else, SC. We have some interest of a couple of companies who are interested in buying us. I'm like, well, why are you doing, pitching here? Like you should be optimizing for your exit. It's a first-time entrepreneur. For him, it's going to be a life-changing event. Whether he wants to use the money to buy, 5 Ferraris or to go, start another company, doesn't matter. But that is an opportunity that you want to take advantage of. It's like, yes, but I don't know. I mean, how should I handle that? I'm like, who's on your board? Where is your board? Like, how are they going to help you get there? Well, actually, that's the problem because, we raise money from these people who, whatever, family office who honestly doesn't care, doesn't know, it's not really their focus. So they're not, kind of asking for the discipline required that an investor, like a professional investor, will be a little bit breathing down your neck. But the reason they're breathing down your neck is because they want to maximize the upside, right? So if you have a good investor, they're going to be like, you have an exit opportunity? Okay, go create a data room, reach out to like another 15 buyers, maximize your, and if you don't have a great investor, you're just going to miss out on opportunities. So that's another, like, get smart investors.
Yeah, I think that, I see from my clients, those that have really great VCs, the trajectory is just different. It's just very,
different
very
trajectory,
different.
yeah.
And it just brings a whole different level of discipline, to the company. So just, going on a little bit about the entrepreneurs. I think it was George Zachary of Charles River Ventures who said that, the great entrepreneurs that he encounters are these folks that have this almost all-consuming, almost self-destructive desire to win. As you think about the great folks that you've invested in, or that you've come across at Facebook, other companies, are there any general characteristics that you can point to and say, wow, that individual, is going to be successful because of this or that?
Mm-hmm. Yeah, so there's this idea that there are geniuses out there, and some people believe that we can go all philosophical on that with Hegel and so on, but I don't. I believe that great companies are team efforts. Yes, a visionary is required, but if you're not able to build a team, and that's why I'm so glad we're going to be talking about culture, you cannot build a successful company. So what I would say is, the characteristics that we look for in a team, in a founding team or an early management team, there's 3 characteristics. And I learned them because when I started Rendezvous Labs, one of the things I was looking for a co-founder. And I had a few people interested, but I wasn't sure they were going to be the right people. So I started a network called Founder Dating, which is professional matchmaking for founders. And so through that network, it's much easier to go say, hey, Rogers, hey, Rogers, I'm alone. I'm looking for a co-founder. It's never going to work, right? Rogers is never going to want to team up with me. But if I tell him, like, hey, I know you're looking to start a company, and I have a whole network of thousands of co-founders, including me, and I'm going to screen you, so I'm going to get first pick at matching you up, right? Then all of a sudden, I had my pick at pretty much any co-founders. So through that process, I interviewed thousands of potential founders, and what I learned of what makes a successful founding team or early management is, 1, you need to have complementary skill set. So not all engineers, not all salespeople, complementary. 2, you need to have compatible communication style. You can argue, you're going to argue, you need to come out positive at the end. And then 3, you need to have comparable appetite for risk. The last one is for this reason, right? Let's say you're starting a company. You want to go IPO, and your co-founder, he just wants to get the 5 Ferraris, right? So it's like $10 million versus $1 billion. And let's say now an offer comes for $100 million. And you're going to be like, excuse me, that's an insult, right? Like $1 billion or nothing. And you say, wow, 100, that's like 10 times 10. That's like 50 Ferraris. Right? So if you don't have a similar appetite for risk, your company is never going to succeed. So these are the 3 big characteristics.
Great advice. Just finishing off on this topic, are there any unwritten rules of Silicon Valley? Everybody, just about except for 2 people, are not from Silicon Valley. Are there any unwritten rules of Silicon Valley? Now you're on the other side in venture capital, that you can say, just don't do this, stay away from this, that people should be aware of?
Yeah, so Silicon Valley is one of the most open places that is out there. But at the same time, it's not just like, you're brand new and everything is going to happen. So just like everywhere else, you have to pay your dues, right? And so people coming in, like, for example, just arrived or still sort of like kind of one foot here, one foot there, thinking, oh, I'm just going to go talk to a few investors or team members and I'm going to, make something happen. It doesn't work that way. You have to sort of really get immersed in the ecosystem. And so the key is here, like, how do I become an insider, right? Because when you arrive, no matter how open and how friendly people are, you're not an insider. So you want to make sure you're part of, you join a lot of network. You want to make sure you add value before you ask for value. And then it's going to take some time. And you want to think of it as a repeat game, right? Somebody who comes in says, oh, I'm going to start a company, make it big, and then go back home, right? Not going to happen. You want to start, one company, learn a little bit, and then the next company you go a little farther along, and then the next one you go a little farther along. It's really a game of repeat, like until you succeed.
I think what you're saying in a nutshell is you've got to become part of the Silicon Valley mindset.
Ecosystem, yeah.
Yeah,
exactly.
One of the things I would say is, in terms of the unwritten rules, what I found is investors can spot a mile away, and that's spray and pray. People think Silicon Valley streets are lined with gold and it's all rainbows and unicorns. And so they'll just do one email and shoot it out to
Oh, yeah,
500
the
investors. And
BCC email.
yeah, I mean, I think investors can smell the spray and pray, and I think Silicon Valley is a very small community at the end of the day, and investors definitely do talk. So just getting back to Moatti Capital, what is it that you're looking for? What stage, and what's the focus of your investments?
Yeah. So, again, we look for investments where we're going to really add value. And the value of, this very large distribution channel, right, product network, is once a company has identified a viable service offering and is on the growth phase, right? So we look for Series A, B, or C. We'll get to know you but before you really start to have, 5, 10 customers, paying customers, loyal, happy, that's not the time that we will add the most value. It's really at that, like I have a product that is catching traction, and I want to accelerate that traction. So Series A, B, and C. And then second is we invest where we have the strongest network. And so right now, we define in very simplistic terms, we say mobile and genomics. Mobile, honestly, is kind of like saying I invest in the internet. It's like we do technology. So we'll do more B2B and maybe a little less consumers. But includes AI, includes data and stuff. And then genomics, that's because the second largest segment of products that count is in life sciences. And so what I think about is, for the past 10 years, we've collected this immense body of mobile data, and we've developed services on top of them. Now let's take these kind of services and apply them on the genomics body of data. So mobile data is everything outside of us. Genomics data is everything inside of us. And then there's a lot of value-add services that are going to come on top of that. So what we've seen is over the past couple of years, a lot of the product managers at Products That Count, they have gone from tech to, digital health, genomics, personalized medicine. And so that's where we invest. And then in terms of geographies, so stage, industry, geographies, we invest in San Francisco, Bay Area, and New York.
And the average size checks that you write?
Yeah, so we come in together with a large venture firm. We will come in with a benchmark, Mayfield, and so on. And so we write a check that's $500K to $1 million.
And so you'll put the syndicate together for
we
these
can
folks?
do that. So we are brought in various ways. We are brought in by the entrepreneur who says, I've gone to a lot of events at Products That Count, or I've worked with USC or with a previous partner. We're brought in by a lead investor who says, I'm forming my own syndicate, right? 90% of deals are with syndicate, multiple investors. And I know that this company will benefit from a product network. So we're brought in by the investor. And then in some cases, we create the syndicate.
Okay. So you've said before that you look for companies solving really big and hard problem with a sustainably differentiated solution.
Yes.
I heard you say a couple of times traction. And what are the key ingredients that a company will have to get funded by you, or at the Series A stage, in terms of product development, team, customers, traction? And I know I get this question just about every day. Do we have enough traction? To be honest, I have no idea what traction is, but what's the profile of the companies that are coming to you? Obviously, B2B traction is very different to B2C. But as you think about your companies, what do they look like in terms of product, team, stage?
Yes. So if you go to our website, you'll see the very first post is like, how do you create a killer pitch deck, right? And so the story goes like this. Like we meet a lot of companies say, oh, see, like I cannot tell my story in half an hour. I think you can tell your story in 30 seconds. I'm actually going to tell you your story in 30 seconds, quote unquote, and I'll answer your question. So we are a unique team, right? Unique team is show us what is unique about that team. It's a diverse team. It has some special IP, some special experience, right? We are a unique team solving a big and hard problem. Like big, it's like size-wise, but hard is emotional-wise. So when I worked for Facebook, I remember I had the opportunity to pitch to Mark Zuckerberg a couple of times. And the way to get him to approve a feature or something was not to show him numbers. It was to make him feel the pain. So you tell him, like, you see, like, when our whatever billion users, they click here, and then they click there, and then there's this that happened. You can see like a physical pain reaction. Okay, let's fix that. If you show the numbers and stuff, it's not the same, right? So big and hard problem, it's an emotional reaction that's going to make people want to buy your stuff. So we're a unique team solving a big and hard problem with a sustainably differentiated solution. So why that's important? Because here, like, very often an entrepreneur will go and talk about like the features and stuff. That's not what we're looking for. What we're looking for is once you get to that point where you have traction, and we don't doubt you will get there, then big companies and small companies are going to say, oh, that's what works. Okay, let's copy this. And how do you still win at that point? When the big ones, they use their big muscles to copy you. The small ones, they use their speed to copy you. How do you continue to win? So unique team solving a big and hard problem with a sustainably differentiated solution. As a result, we have great traction. So traction will be a number of customers, will be revenue, velocity to the revenue. Which we monetize fairly. And fairly is really simple. It's like, is your business model, how you charge, going to align with how your customers are buying? So you can say, I have a subscription model, performance-based, but you don't want to have like kind of misaligned incentives. And so as a result, our financials look very promising. So show very simple financials. Common mistake, again, is we see like some people show us like a full balance sheet. I was like, okay, so now you've lost like half the room because everybody has to prove that there's a mistake in the numbers as opposed to listen to you. Like, don't show big complex charts, right? Just show us like a nice hockey stick. Have you seen, Rogers, the hockey stick go the other way?
No.
Me neither. I wonder why. Okay, but to get there, we need money, right? So we need money. So we see some entrepreneurs, like they present their idea, they present everything, and then they stop right there. So a little bit teasing, we ask, like, so are you raising money? Well, show us that you're raising money. It's sort of like saying, my husband, he races Ducatis. And saying, let's buy a Ducati, but I'm not going to tell you at what price. Like, he doesn't care, but I care.
One thing you mentioned about traction, and I've heard you also speak about pilots. And a number of my clients, especially in the AV space, and where they're solving hard problems, they're doing POCs or pilots with the 800-pound gorillas. And you've said, unpaid pilots, that's just not a good idea.
Don't do that.
Okay, why?
Because so I'm gonna do a pilot with you, and I'll do it for free. Like, you're never gonna care. You're just gonna be like, okay, sure, do your pilot, SE, I don't care.
But I mean, getting Uber or Lyft or some huge company to do a pilot, even if it's free, if it means expending any resources, does it depend on who you're doing a pilot with?
Well, Roger, let's say you work at Uber and you're my buddy, and like, hey, I need a favor from you. I'll do it to you for free. I just want to be able to say I'm doing a pilot with Uber. How relevant is that?
Okay.
And so, and it's really important because as a first-time entrepreneur, you want your product to be successful so badly, right? So, like, let's say I'm building something and I'm trying to pitch it to you. Say, hey, would you use this? Like, you're not going to want to tell me, like, no, this is just like, I never use this. You'd never tell me that. You'd say, sure, if it's free, I'll use it. And you don't care. So the price isn't about, especially at the early stages, it's not about showing how much revenue. It's about showing, like, how much do people care about what you're building. And so free is actually, not a price.
Okay, I believe you partly. Okay.
Well, how much would you be willing to pay to get proof of that?
Yeah, I guess it really does depend on the circumstances, and I think for the most part, you're absolutely right. I love it when I'm talking to entrepreneurs. I do some angel investing as well, and they say, I say like, what about the market fit? And they go, oh yeah, I spoke to my buddies and my family, and they absolutely said they'd buy it. Sure, yeah, that sounds like a winner. Um, so, getting into the funding here, when investors invest, and I'm sure you're the same thing, you do so much diligence on the companies, on the founders, really get to know them. And what really amazes me is that founders do so little diligence on investors. So, what advice can you give to the entrepreneurs in the room in terms of what they should be looking for from investors? And presumably, they're all looking for smart money, but there's smart money and then there's incredibly smart money. So, what's your advice?
Yes, yes, yes. So I have a talk on this where I say, investors are actually not all the same, right? There are different segments of investors. So it's simplified, but it gives a good idea. So you have anyone is familiar with this segmentation, the whales, the dolphins, and the minnows? Anyone has heard of that? So the whales, dolphin, and minnow is a segmentation that's used in the gaming and social industry. Whales, it's maybe 1% of your audience, and they buy all the the shiny swords and the crazy armors, and they bring a lot of money. And so in the world of gaming, when you have a whale, you build anything they want. Oh, you want the pointy boots? Like, sure, I'll build that for you custom, and it's going to cost you a lot of money. And so investors, you also have whales, and they will write you typically like minimum $10 million check. And as a result of that, they'll own you, right? Like you'll have to do everything they say. So you want to, if you first of all, if you don't know how to spend 10 million with your company today, if you don't have like a plan for 10 million, you might not want to take that money. But also you want to be prepared to, if you take the 10 million, give them a huge amount of control. Then you have dolphins. And I like to think in the investor world, Mighty Capital is a dolphin. But in the world of gaming, the dolphins are the people who tell you, like, hey, you really should play Candy Crush. It's really fun. It's great, right? They're social butterflies. So the way you manage them in this world is you give them some great things to say about you because they're going to talk about you no matter what. So you might as well give them something good to say rather than something not so good. Well, in the world of investing, swimming with the dolphins, you want to make sure that if you take money from a dolphin, they're going to swim with you in the ecosystem where you have the most, advantage. So in our world, our ecosystem is product. If you swim with us, we'll get you there faster. And then the last set of investors are the minnows. And the minnows in the world of gaming and social, they're the people who like lurk on Facebook, right? Don't comment, don't like it. Just out there, and the way you manage them is you entertain them. They're here for the show, and so you as an entrepreneur you need some minnows, and you want to keep them entertained, right? Like so you don't want to have too many of them because it takes time to entertain your small investors, but you need them, but you want to be careful because it can have diminishing returns.
So, from your experience, are there any like huge red flags that you can point to for the entrepreneurs in the room when they get a term sheet or when they're dealing with investors? Anything that investors say or do that all of a sudden your warning flag should go up for the entrepreneurs?
Well, so yes, a lot has to do, and many entrepreneurs will not realize that with fairness, right? So if you can raise money at a very high valuation, this is what will happen, right? So I'll give you an example. We see companies sometimes, they come pitch to us, and they show us a valuation as a multiple of the revenue. That's, for example, 50x. Now, anybody here knows the P ratio of Facebook? Anybody knows that? Take a guess.
It's from 18 to 20.
18 to 20, 25. Yeah, so when I see 50x, it's like twice as valuable as Facebook. I had one entrepreneur, he had 100x. I said, okay, so you think you're 4 times more valuable than Facebook? He's like, of course I am.
Next.
But for the most part, that's sort of a point of comparison. So another answer is like, oh, but it's so different at the early stage than it is at the Facebook stage. But it isn't, right? Because if you are 50x today, and eventually you're going to have to go to like even 20x, well, guess what's going to happen at some point, right? You're going to have a correction. And guess what happens when there is a correction? You get affected. I don't, because I have something that's called terms, right? Term sheets. So I don't get affected, but you do. So going for like a crazy high valuation is actually going to hurt you down the line. So that's one common mistake, which is like, oh, I'm going to raise money at a very high valuation because I can. Try to get something that you think is fair for the long term because it will work to your advantage. And then the second thing I see, and so that's like entrepreneur, be careful. Now, investor, be careful. So here's what I see at the early stage. You're going to start, you just moved here to Silicon Valley, so you're not sure what to do. So you're going to join an incubator to help you formulate your idea. And they're going to take like, say, 5-10% of your company for a small amount of money. And then, okay, now you formulated your idea, you're going to now go to an accelerator because they're going to help you get your first few pilots. And they're going to take another like 10-ish% of the company. You graduate from the accelerator, and then you're going to raise a pre-seed round, which is going to take, let's be 10% on the low end, 10% of the company. Your pre-seed is going to get you like a couple customers. Then you're going to go raise a seed round, and they're going to take maybe 20% of the company. So doing simple math, right? 10, 20, 30, 50%. And then you get to Series A, they get another 20% of the company. And then what do you get? You get like, you get an option pool, that's another 20%. And then you get maybe 10%, and no other investor is ever going to want to touch your company because there's nothing left for them. Or, if there's something left for them, what they're going to say, hey, we're going to take that pool of 100, and we're going to squish everybody, so make everybody mad, and we're going to take our, 20-30%. So that's a big mistake.
Cram down.
Cram down.
Yeah. So for the entrepreneurs, are there maybe 2 or 3 questions that every entrepreneur should ask, their potential investor before they actually take money from them?
Yeah, so the first thing is when you do your due diligence, are you actively investing in our space right now? Because a lot of investors are out there and they are not actively writing checks, but they won't tell you, I'm not writing checks, because otherwise you're going to say, well, then you're not an investor, and then what's their identity, right? You don't want an identity crisis. So are you writing check in our area right now? And then second question, what kind of value are you going to bring to the table, right? Like your green dollar is just like everybody else's green dollar. So what is the value that you're going to add to my company? And then thirdly, especially if it's somebody who's going to have like an involvement on your board or something, like who are you going to bring on my board? You want somebody you get along with, right? Because you're in for the long ride. You're in for, 5, 10 something years, probably more.
I would say before you ever get to that investor, we normally like sit down and scope out the top 20, narrow it down to top 10, then get to the top 5 and find the particular venture partner that we want.
Yes.
And then, go and talk, because otherwise it's just like a bit of a roulette.
Yeah.
So just, last question on funding. You've mentioned one mistake, people taking too much too soon. And maybe accelerators giving up too much too soon. Are there any other mistakes that you consistently see folks making in the fundraising besides the slide, which is like we have no competition, or anything other that you can point to in terms of mistakes?
Yeah, and so the other one is, and I ask every entrepreneur that question, like, what is your exit strategy? It's a very important question, and I care a lot less about the actual answer than the process of the answer, right? answer type number one to avoid. Oh, we plan to run this company forever. Well, you've just told me that you don't care about my success, right? As an investor, for me, the difference between success and failure is you have an exit, I succeed. You don't have an exit, I fail, right? So if you want to run the company forever, that basically means you want me to fail. So that's mistake number one. Mistake number two, oh, there are different kinds of exits, like lecturing, like we could go IPO, or we could get acquired by Google or Salesforce, or, I'm like, okay, get me out of this. Like, this is not a viable exit plan, right? This is just sort of like dreamland and unicorn, like, theories. A good answer would be, we have 2 exit points. We have an early exit point right after we raise our, I'm just making this up, right? But right after we raise our Series B, and show like further traction, reach profitability, we could get acquired by this types of buyers. And then if we don't stop there and we continue for another 2 rounds, then we have the possibility to get maybe go public or maybe get acquired by this other type of buyer. But really carving out your exit path, because it's so much easier when you have a plan to work down your plan and make sure that you and your team become incredibly wealthy and successful out of that plan, rather than sort of go randomly and let yourself be, bounced around by your investors, and at the end of the day, you get nothing.
Okay, great. So we're just going to switch gears. I know you wanted to talk about culture.
Yes.
So what is company culture to you, and how important do you think it is to a company's ultimate, success?
Yes. So, I'm an engineer by training, right? So for the longest time, like, people would talk to me about culture, and I would be like, oh, whatever, like, let me just go do my spreadsheets, right? And I really didn't believe in it, except now I think it's like one of the most important success factors. So the key to successful performance, like to high performance, is you need a plan, right? You need a strategy. And then when you get off the plan, because you're going to get off the plan, you need a way to get back on plan, and that's culture, right? So you need strategy and culture as your sort of the science and the art of getting to high performance. And so that's why I think culture is so critical.
So what are the fundamental pieces, to put in place to build that culture?
Yeah. So a few things. There's actually a really, really great book on this called The Science of Total Motivation, which I love the title, but it's a really excellent book. And it talks about 3 key motivators of people, like play, purpose, and potential, right? Play is like, am I having fun at what I do? Do I enjoy what I do? Like, am I present on a day-to-day basis? Purpose is what I'm doing, changing the world, moving the needle of some important problem. Like, what I'm doing here, like, am I doing it for like a greater good? And then third is potential, which is like, well, I have personal goals and career goals. Like, is what I'm doing today pushing towards, my overall personal, career, professional direction? And so I think that you want to build a culture around like, play, purpose, potential.
So what are some of the challenges that you see in companies, probably in Facebook as well, right? It had probably a very different culture, and I see this with clients. As they grow, the culture changes. So what are some of the challenges in building and maintaining that culture?
Yeah, well, there are a ton. In fact, I heard, I was very fortunate, I heard John Chambers, the former chairman of Cisco, talk about how, like, the business cycle, right? He said, well, when I was at Cisco, you had to reinvent the company, reinvent yourself maybe every 7 years or so. But now when I talk to young people, I tell them like every 3 years you have to reinvent yourself, because that's how often the business cycles evolve, because things go so fast, right? So if you think about that, and you look at, okay, so these business cycles, like, what is it really about, right? And so much of business is about managing risk. So if you say, like, every 3 years, I need to, as a company, change my risk profile. And therefore, as an employee, right, I need to have a different appetite for risk or attitude towards risk. Then you look at a company like Facebook, taking risk, like move fast and break things. Taking risk is encouraged. And then you look at a company like Mercedes, taking risk is a bad idea, right? Shipping a flawed Mercedes is wrong. 10 years ago, and today, Facebook has changed their culture to not move fast and break things, but just move fast, right? So a lot less risk. And Mercedes is, I'm not privy to their strategy, but I'm pretty much sure that with Uber and stuff, they're moving more towards like a service-oriented rather than product-oriented culture. So a lot more risk, right? So the people who used to work at Facebook, super risk-oriented. People who used to work at Mercedes, super risk-averse. People who work at Facebook today and at Mercedes today, a lot more similar. That's a huge culture change.
I think one of the things that I sort of identified with and was born out, we did a fireside with David Gurley, who's the CEO of Symphony. And at the time, he was just, I think he was taking $60 million on a $1.5 billion valuation. So he built a pretty big company here in New York and Singapore. And we were talking about culture. And he said, even today, he still interviews all the big hires. He's integrally involved. He just cannot allow someone to come in that potentially doesn't fit into the culture, because that person can destroy, just like a cancer.
Yeah.
So I think for the entrepreneurs, it really is something that people kind of gloss over. And but the successful companies that I see, the startups, really do have a great culture. So I know we've got to wrap up here. Our last couple of questions. Obviously, everyone's talking about AI, was ML, DL, now it's AI. Are there any other sleeper opportunities that you see out there that are potentially going to become interesting, not only for you, but for other investors?
Yeah. So I talked about the two platforms, right? The mobile platform, right? The mobile data set, and the genomics platform, the genomics data set. I think the next one is going to be the blockchain platform, and the announcement yesterday was sort of a one step in that direction. I think it's definitely too early for that, but that's sort of the next big platform.
The announcement by Facebook?
Yeah, the Libra announcement, yeah.
Okay, and just last question from me. We're going to have a whole ton. But anything that, any words of wisdom that you can impart from the entrepreneurs related to funding, related to building, scaling a great company, anything that you can impart in terms of, suggestions, advice, wisdom?
Yeah, I would say that, a lot of our own culture is that it's like actions speak louder than words, right? So you could, go to like 1,000 events, you could speak to 1,000 people, but having one customer, raising money, shipping a product, that's really what matters.
Excellent. How about you, Rob?
Let's hear it for SC and Roger. So we have a full 30 minutes to take questions from the audience. We want to take as many questions as possible. I would like everyone to use the mic. Please, it's not a pitch event, so no pitches or thinly disguised pitches. So who's got a question for SC?
Thank you. Hi, my name is Colleen Tan. I'm a.
Here you go.
Oh, thanks. Sorry.
I'm a service provider. I'm a sales consultant. I have two questions. First one, the first 10 minutes you mentioned about to build your network. And I understand that we try to build the network until your very last sentence earlier. You mentioned about as long as you get a customer, that's what it matters. So the first section you also mentioned about the podcast that you created, like kind of spark the network. So in your view, what is the most effective way, or how do you evaluate you are in the right direction in building your network? I guess maybe it's differentiate from product to product, but I just want to know your view. And then the second question is more for my son. I heard that from different sources for Facebook and Google, if you graduate from Harvard, Stanford, those elite colleges, your starting salary is much higher than other college graduates. So as an investor, do you also use the school or the education as one of the factors, like how much money you're going to invest, or if you're going to invest in this startup?
Yeah, so the first question I want to make sure I understand is, how do you build your network?
Like, how do you know when you, just like earlier you mentioned about you go to 1,000 events and you try to meet a lot of people, how do you evaluate, how do I evaluate I'm in the right direction in building my network that will help me to build my business?
Yeah, I'll give you my networking best practices, right? So I have my business cards here, right? Like I go to an event and I give my, I give my business cards like this, right? I'm talking with you, and I'm going to give my business cards to everybody around, and while I'm talking with you. What that does is, first of all, half of the people who will, be around you, all they want is to follow up with you down the line, right? So you just save them time by doing that. They don't have to wait, say a few words, here's my card, go. I suggest you do the same. Like a lot of people are going to want to talk to you because of XYZ reason. You may or may not have the time to do that, but at least you give them your contact info. They can follow up with you. So that's sort of like I build my network at scale. And then that's the first advice. Second advice is you have a conversation with somebody. You have to come to an event with sort of an objective in mind. Not like, oh, I want to find a customer, but I want to come out of this with like a meaningful connection, right? That will help my business, my personal, whatever. And so you have like maybe a couple of qualifying questions. So you talk to somebody, you just ask a few qualifying questions. Let's say you're looking for customers and you're selling like a service, like let's say you're selling marketing services. Hey, you have a company. Oh, great. Do you have a live product? If you don't have a live product, you're not going to do marketing. Do you have a live product? No. Okay. Oh, great to meet you. You don't need to be totally, you can be polite about it, but that's a connection that is not going to add value for you. Move to the next person. Oh, you have a product out. Great. So do you have a sales team, a business team? Oh, great. Well, maybe I could chat with you. Let me, take your card. That's your reminder that you're going to follow up with them. Take your card. And I want to tell you about some ways that I've been helping people with their marketing and accelerated sales. So you want to be very sort of very purposeful about, a few qualifying questions. This person I want to follow up with, and then move to the next person, right? So you take their card as your reminder that I'm going to follow up with that person, and you move to the next person, and you come out of the event like some people very extroverted, they will want to have 10 conversations. Some people very introverted, like one is enough. I have my card, I have my follow-up, I'm going home. It's fine. You just have to know how many cards you want to take at the end of the evening.
I think you hit on one thing I just want to mention. The most successful people that I see that have incredible networks are the people they give before they actually want to take.
True.
And then, I've got some folks that I just call them connectors. Because they're always just, I should introduce you here, do this, do that. And they have the most incredible networks because people see them as not takers, but as givers.
Yeah.
And I think you mentioned something about that earlier on. I just wanted to mention it because I think I see so many people come to Silicon Valley and it's almost out of desperation that they're just going and networking, trying to get everything that they can possibly get.
Yes.
And I think people realize that and they sort of shy away from it.
Yes.
But if you're giving, someone's going to be much more likely to give as well because you're giving first.
Yes. So I agree completely with that. And that was completely. And then, I think there's sort of different levels of engagement with your networking, right? So what I just described is how you kind of join the conversation. It's relatively passive, to be honest. You're at an event, you participate, make some connections. There's another level which I think I would encourage all of you to be a part of, which is exactly what you're describing. You shape the conversation. So you will have, you hear the talk tonight, and then you go talk to this person and say, hey, what did you think of what SC said? I thought that was interesting, but yeah, I heard this other talk and they said something different. You try to, influence and give your opinion and shape the discussion, right? And that's when you start to really add value. It's like, oh yeah, I hadn't thought about that aspect. And actually I read that book and all of a sudden there's a different level of networking there. And then the third level of, is what I call drive the conversation. That's what you're doing and Rob is doing. You're hosting the event tonight. So you're basically like the matchmaker, right? You're saying like, everybody come to me. Maybe you'll get some business out of it. Maybe you'll get like your reputation for creating great events. But you're all of a sudden like a centerpiece for the network, right? You're at the center of the network. That's sort of driving the conversation. So join, and soon after that shape, and then drive the conversation. And then your other question was about like salaries. I have no idea how Facebook and other companies do their salaries, so I'm not going to comment on that. And whether I use that, forming a perspective on people is really an art. Like I don't think there's a science. I'm not a trained psychologist. I'm not an HR professional. But I certainly have my own filters and biases, even though I try to have as little as possible. So education is one of many different factors. Education, experience, rapport. It's there. It's not a main selection criteria. But it is what it is. But the other thing, and I give this advice often to young people, like students, come to me and like they'll ask me a very typical question, like, oh, I want to get into product management, or I want to get into venture capital. How do I do that? Because the problem is I don't have a technical background. Who said you need a technical background in life to do anything? Nobody except you, right? So, or I want to get into this AI company, but I don't have a background in AI. Well, who cares? So if somebody is giving you an objection, which most people aren't, I'm never going to tell Roger like, hey, you don't have a technical background. I'm not going to do anything, work-wise with you. No, that's not how the world works. It's sort of everybody has their internal barriers. But should somebody ever tell you, like, well, I'm not going to give you the job because you don't have a technical background. Well, first of all, go take a class at General Assembly, and then you come back, you say, hey, look, I check your box. I have a technical background. And then second, you can also, just like mentally, like don't say that out loud, but mentally say, well, what kind of expert are you to tell me that I'm not an expert? It's like, no, I am an expert.
Just to that point, I think, when you were asking about schools, I don't know about salaries, but, VCs do have biases, or what, maybe it's not, biases is not the right word, but I think they do look at teams that have come from great schools. So if you've got an engineering team that's come out of Stanford, or the CEO is an MBA from Stanford, it sort of gives them a second look where they may, if it's just some unknown, they may not be as interested initially. So I don't know if that's your experience. Maybe it's just unconscious biases that when you see people, great teams from great schools, it sort of shapes your initial idea at least. It may not carry them, but it may help open doors.
So a degree matters, right? And I had a whole point of like, don't be a dropout. Yes, which degree matters, but the farther away you are from that degree, the more what's in between, right? The experience also matters. I come from France, where you get a degree and your path for life, like that's it. You're on a certain trajectory forever, right? So that's why I left, because I was actually in the upper echelon of the whatever. But it's such BS, right? That's why we're all here, because we don't want that kind of rules. So some rules are still here, but there are so many ways to break these rules and just like be the expert and say like, what kind of expert are you to tell me that I'm not an expert? Because I am an expert because I say I'm an expert.
All right, next question.
There's someone here.
Right here.
I think,
Oh, okay.
sorry. Sorry. Yeah, I think.
I
Rob can-
apologize. I think I learned a lot from you today. Bonsoir. Okay, so first of all, I have a question. What kind of advice, you didn't mention that, okay, build one thing, build one company, sell it, and then, move to the next one. And I have a tendency of like having so many ideas about things I want to build that are all great ideas. But I have a company right now. At what point do you really decide to sell that one first? Are you selling from weakness or from strength? Sometimes you want to build it so that it's strong enough, so that somebody who's buying it is buying it from a position of strength, not you selling it. Or at what point do you let go of that?
Yeah. So first of all, like you're never selling a company. Like somebody is buying your company.
Oh, okay.
Right. You're like, Rogers, do you want to buy my company? Like, no. He would come to me and say, hey, I want to buy your company, right? So they are buyers more than they are sellers. And second, like this is the very typical trajectory of companies, right? When they are successful, so there's like a rise, and then there's some bump on the road, and then maybe there's another rise, and maybe not, right? Most of the time, you want to sell right here, like when you're on the rise, before you hit like a kind of major bump on the road. And most of the time, people have hit the bump on the road, and they're trying to get there, but they're not successful, and they're like, oh, now I'm going to sell. Like, who wants to buy? At that point, nobody. So as soon as you start getting, if you ask me, as soon as you start getting real traction, you start forming partnership, and you start seeing like which of these partnerships 2 years down the road or one may lead to an exit. That's my advice for you. If you're over there, I don't know. You're a little too late.
Fireside. I think there was a question here. Right?
Over here. Hang on. Do you have a question?
Yeah, it was right here.
Yeah, I'm just wondering, you had touched on that a little bit already, but I just want, maybe you can elaborate a little bit. How can, as an entrepreneur, how can we level the playing field between the investors and entrepreneurs? In other words, like, they can pretty much due diligence us, 360. But for us, a lot of information from VC is very closed door. So how can we really, get a little bit more advantages or being fair to us in the sense of how to assess them, and also maybe a little bit too long the question. So like I know some entrepreneurs don't even get VC money; they just get angel investors. Maybe can you also talk about the pros and cons of getting just angel investor money and VC money, and also the strategic investors like corporations?
Yes, so there are so many different ways to answer this question. When you're at a very early stage, taking money from professional angels, not angel, professional angels.
They know the field.
Not technically savvy angels. Professional angels, like investors who invest their own money, as opposed to other people's money. So I'm not talking about like, this person is a great AI engineer, and they're going to give me $20,000 to, build my program. No. Somebody who has made 30-something, 50, whatever, investment, and is looking at making money from their investments. That's the kind of angels you want. And it's fine to take money from that at an early stage, because that's a good risk profile. And then after that, like if you're successful with their help, growing your company, which I wish to most of you, then they will, because they are professional investors, they will, just like you were explaining, like a list of 20 down to 10, they will introduce you to venture capitalists who can take it to the next stage. And as you do that, you'll get some venture capital money, and then you'll reach a level where you are ready with your operation to get some scale, and then they will introduce you to potential strategic investors who will sort of give you like a global reach, distribution, and so on. It's very simplified, right? The world is a lot more kind of complex than this, but at a sort of very simple way, that's how you start.
But what about leveraging the playing field?
But what do you mean by that?
Like in business school, we learned about the technology a long time ago. Like really, I attended some of the seminar here. You know, have a good lawyer definitely look at the term sheet for you. You know,
Oh, so
along
terms.
along that line, yeah, so that you can protect yourself and also due diligence on those investors. But from the outside, we only can see the website and what they invest. And fortunately, I had the network of my MBA school in which I know some of the people. Two of them, I will know some of the people. But for other people, may not have that network.
Right.
So how do we, from the outside,
Well,
is how
exactly through a great lawyer like Rogers, like who will have the connections, who will understand all the terms, and will be a neutral party, because you as the entrepreneur, it's your baby, you're not necessarily neutral, and the investor, not necessarily either. Neutral party who will negotiate together. So don't do your own negotiation. Hire a lawyer who's reputable, insider, and will help you navigate that.
I think one thing that I always advise my clients to do, if we don't know the investor, so if it's the East Coast investor or whatever, is to do their own diligence and not ask the investor for references, because they're not going to give you any names of people who they've run into the ground. But go to the website, look at all the portfolio companies, and maybe pull 5 or 10 names, call the CEOs and say, hey, in 2008 when Q4 hit, how did the investors react? Was it crammed down city? There was a very large, well-known fund in Silicon Valley that, Q4 08 and Q1 09, they really put their portfolio companies through some incredible pain and taking advantage of a downturn in the economy. So, talking to other CEOs, that you've picked yourself, is a good thing to do due diligence.
Okay. Thank you.
All right, next question.
Hello, I'm Q. So I'm a younger person trying to start business, and I was wondering about those inevitable biases that you might have on younger teams, and also how would you advise younger people to get some people who have more expertise and experience in the field than you?
So, young, old, immigrant, native, women, men, all of that is makeup. And so what I would say is if you're an entrepreneur and you're trying to build a business, you never want to identify yourself with skills or characteristics that are not like from your trade. That would be my first recommendation. So if you come to me and you say, I'm a young person, it's irrelevant to the conversation. You're an entrepreneur and you're building a company, and your biggest challenge is you have a great product and you're not hiring fast enough, or you have a very good idea and you're not finding the right resource. So make the conversation about your trade, not about you. That would be my number one advice.
I think just also, further to that, I think a lot of entrepreneurs have a really tough time looking at their company objectively. And I always try and say to my clients and people that I invest in, say, why is your company different? Out of the hundreds and thousands of deals I'm sure that you see, what is it about your company that really makes you stand out? It doesn't matter that you're 21. I've got an entrepreneur I just found out, we had a really big raise and I took him to Fleming's for a closing, and I said, we're going to have an incredible bottle of wine. And the waitress said, I'm a little embarrassed, but can I see your ID? Not to me, to the entrepreneur. And he was 19. We'd just gone through YC. We closed on $8 million, and we were totally oversubscribed. I had no idea he was 19. But I think one of the things that you've got to think about is, from an investor's perspective, investors are looking for an investment where there's no risk and unlimited upside. Well, that doesn't exist, right? So,
That's a good
you
summary,
know,
though.
pardon?
It's a good summary, though.
Yeah. But, it's just a question of risk. And what have you done to mitigate the risk? It doesn't matter that you're 18 or 19 or 50. If you've built a great team, you've taken away a lot of the execution risk. If you, have already built a product, the technological risk is mitigated. And you've got all kinds of patents, so the sustainability risk is diminished as well. So just think about why your company, why your team, why whatever would be a really attractive thing for investors. And I think age is just a number. I mean, it really,
All right, next question.
You said that you go and give cards.
Hang on.
My first question is, how much time a founder should devote in marketing or networking? Because it takes toll from the product development and engineering work. That's one thing. Secondly, you said that you go and give cards to people, And of course, people give you cards also. Do you read them? Do you follow them if somebody gives you a card? Because that also takes a lot of time.
Yes. So your first question is, how much time should I spend on networking versus on building my product? At a very early stage in a company, when you don't have a product, that's what you need to do. But immediately after you have some prototype that is barely sellable, then you need to go sell it. And the number one job of a CEO is sales. Like if I had to do my life all over again, I am an engineer by training and then spend this time in product. I would say like the one skill that I would pay a lot more attention to is sales. I used to think that sales was uncool because engineering was the cool thing. But the truth is the only way you succeed in business is if you can sell, and you sell all the time, like 100% of the time. When you create a business, you sell to potential customers, you sell to potential hires, you sell to potential investors, you sell to potential referrals, potential vendors. You sell to everybody. You sell a different value proposition, right? To a customer, you're going to sell your product. An investor, you're going to sell like your equity. A hire, you're going to sell like benefits and so on. But you are constantly selling, and it's sort of what you have to do. So networking is business development. It's part of selling because you never know. Like here, you can meet customers, investors, hires, vendors, referrals, but your product should be a very, very, very distant goal. Like should be built by your team. You as the CEO, you're always selling. And then you ask, like, when I get business cards, how do I follow up? So everyone has their own method, right? But if you get a business card that is going to potentially advance your own goals, then it's on you to follow up. And there's also this myth. So sometimes entrepreneurs will tell me, hey, I haven't followed up with that investor that you introduced me to because I don't want to be, too pushy. It's like, well, what do you mean you don't want to be pushy? I made an introduction, first of all. So the fact that you're not following up like timely means like, what is it? Are you unprofessional? Are you unavailable? Is this a low priority? Do you not care? No. If something is important to you, you follow up, right? Because if you don't, then you're basically communicating to the person it wasn't that important. So if it's important, it's on you to always follow up.
One thing on the follow-up, I don't know how you feel about this, but what I often advise clients to do is when they, identify investors that, may be interested in what they're doing, is to and create a list of people, advisors or investors, and consistently provide updates. Hey, I just want to let you know, had a killer month. We did this, we did that, because I'm not sure if you're the same, but most of at least the early stage investors, and myself included, we don't invest in people that we don't know. And so, when you're consistently getting updates from entrepreneurs, you're thinking, wow, they're just executing the heck out of everything, right? Because every email you get, it's all this incredible news about what they're doing. I mean, do you like to get emails like that?
Yes, absolutely. With entrepreneurs, and we'll tell them, right, if for example, they come to us, it's a little bit early, we'll say, if you have an investor newsletter, please add us to it. Absolutely.
So they really are too early. It's not just a cop out like. Hey,
so that's a good point. Like, very often, like when entrepreneurs hear that answer, you're a little bit early. They often hear it as a rejection. So we try to be incredibly straightforward. And so when we say no, if you've received a message from us that says no, then it's no. But if we say it's too early, we actually mean it. Yeah.
Okay.
You just gave permission to everyone to add you to tons of different newsletters.
Absolutely. Nice. I'm serious. Okay. And if you didn't get my card, like, I have some left.
Excellent. Thank you. Going back to, my name is Cheyenne. Going back to conversation about mobile, you mentioned you wrote the book because mobile at the time was new. Did you mean it was a new way of engagement? I wanted to know, how do you think about all these new technologies like voice-enabled devices, chatbots? Do you think mobile still is primary engagement vehicle, or now how you see the landscape and your take on that?
Yeah.
Thank you.
So it really comes down to how do you define mobile or mobility, and I think it's two things. It's identity and context. And so it doesn't matter if it's a smartphone, a watch, like invisible, just voice. It's still mobility because it's a device that is yours and yours only, right? It's yours. It knows who you are, and then it knows your context. It knows where you are, your friends, your health indicators, whatever. So it knows your context. And that's how I define mobility. I know it's kind of broad. I make the argument that smart car, like the autonomous vehicle, is also mobility, and smart home is also mobility because it knows your identity and it knows your context.
Thank
you. Hi. Thank you for the talk. I have a bit of a curiosity. What do you guys think of this era of big tech in which it seems like it sort of shadows the growth of small startups because they have all these resources and they can wave in when like the things are getting hot, etc. And more specifically, what would you recommend to a team of founders that have gone into a nascent emerging market that it's sort of evolving slowly, and they have the option to be bought by an established company that has the pockets to sort of to bankroll this market that it's developing?
Yeah, so that's kind of two questions. I'll answer the last one, which is if you have an opportunity to sell to Google or Facebook or a big company, it's like, don't even just do it. Right? Don't blink about it because you may I don't know who's in this room, right? You may be the next Mark Zuckerberg, whatever. I don't know, but 99% of companies are going to fail, 1%. And in that 1% that's going to succeed, 97% is going to exit for less than $100 million, right? So the myth of I'm going to be a unicorn and so on. And we ask that question often to founders, is like, do you think you're in the 0.03, top 0.03%? And it's not, most of the time the answer is no. And so if you have an opportunity to exit and especially you're a first-time entrepreneur, take it today. And I'll sort of show you the other side of the table, right? So you take it today, and then you take 2 years off. You go to the beach. You come back, and you say, hey, I came to Silicon Valley 3 years ago. I built my company in 2 years. I sold it to Uber. I took a year off. Now I'm ready to come back and start my next company. Do you know how many people are going to bankroll you when you say that story in 3 years? Now imagine you decide not to sell. So then you've been 3 years in Silicon Valley. You're still a struggling first-time entrepreneur. You say, I've been in Silicon Valley for 3 years and I'm building my company. And you are, it's a world of difference, right? So that's my advice. And then the other part of your question was about, do you remember?
I think emerging markets.
Yes, the big tech versus the small companies.
Yeah, big tech.
Yeah, so here's what happens, right? There's one train of thought, which is to say, if SoftBank wants to give you money, take it, because if not you, it will be your competitor. Personally, I disagree with that, and I'll tell you why. Because if SoftBank gives your money to your competitor, and in most cases it's too much money, so it's not a great potential for return, right? Then your competitor is now on the hook for an incredible amount of growth and has been diluted so much by the investment that they are going to have an incredible pressure for a very tiny upside for them. You, on the other hand, you said to SoftBank, go give the money to my competitor. And then 6 months later, you call your competitor, you say, dude, I could boost your growth by this much if you buy me, and you get a much better upside this way. It looks smaller, right? So it doesn't seem as cool, but you have actually a much greater potential to be additive to their growth by selling to them. And then you do the scenario of, go bum around on the beach for a year, you come back, you say, hey, we sold our company to WeWork, and now I'm starting my next one.
Let's hear it for SC and Roger.
I think there was one more there.
Oh, all right. All right, last question.
Thank you so much. My name is Armita. Thank you so much for your talk. I learned a lot. I wanted to ask about the co-founder dating site that you talk about. So I think it's very important, as you touched on this point, that how you find the co-founder for your business idea. Appetite for raise and risk taking kind of so appetite, the two things that you mentioned. I don't remember the third one. I know that you mentioned that, but if you can dig more into that, would be great.
Yes, so I can tell you a couple of things. First, the 3 criteria, right? It's like complementary skill set, compatible communication style, and similar appetite for risk. If you go to our website, you'll find somewhere in the blog, you'll find an article on this, and a quiz. You can take a quiz of 10 questions. And the most interesting, the quiz is supposed to be funny. I wrote it a few years ago. I don't know if it's that funny anymore, but it was supposed to be kind of a fun thing to do. And what's really interesting is to read the answers. And especially if you're considering a couple of co-founders, ask them to take the test, and then you review the answers together. You say, oh, why did you say that? It's not so much like what the answer says, and more about how you guys discuss the answers and what's the reaction, right? Because that tells you about them. So that's the first thing. Then the second thing is, a lot of people are saying oh, I'm searching for a co-founder, so I'm going to go on LinkedIn. No. Relationships are built at events like this. This is why what Rob is doing and Rogers is so important, because this is where you're going to find your co-founder. Right? You go to these, you go to another one, you go, and then you'll see, oh, you're here too. Okay, what are you doing? What are you looking for? And then back to your question earlier about networking, you're thinking about finding a co-founder, so you're going to ask hey, what's your background? Because I'm a business person. Oh, you're a technical person. Oops, complementary skill set, right? Hey, you talk to them a little bit like, what's your communication style? Are you like extroverted? Are you more like analytical? You're going to get a sense for the communication style, right? When you say, oh, what kind of company are you building? Like, what are you looking to build? Like, I have an exit opportunity, but I'm never going to take it because I want to go IPO. Okay, appetite for risk, right? So you ask, like, in that networking, a few qualifying questions. You don't have to, like, go, like, with a checklist, right? You ask a few qualifying questions. All right, great talking to you. Hey, can I have your card? Because I want to follow up with you. I have a few things I want to talk about. Move to the next person, ask the same questions.
Yeah, one of the things on risk, one of the things that I see really where the wheels, come off the bus pretty early are folks that come in from large corporate, and they've got sort of this romantic notion of a startup.
Yes.
And there's just nothing romantic about startups. It's just freaking hard.
Yes.
I mean, it really is. And so, where there's no salary and they've come from big corporate, large salaries, just, it's different maybe from Google and Facebook because it's so entrepreneurial at some level, for people going in. But otherwise, people coming from, large corporate coming into a startup, it's tough. It's a really, really tough adjustment.
It is.
And it's just one thing when you do get co-founders, splitting the pie is really important, but then putting the right vesting on the shares so that you don't end up with someone that doesn't work out that takes away a big chunk of your company.
Yes.
Is really, really, really important.
Yes, and signed agreements. Absolutely, it's really important at the very beginning. Yeah.
All right, take two. Let's hear it for Esty and Ron.
If we had one more question, we could get a third round of applause.
So feel free to stick around, talk to Roger and Esty one-on-one, network, socialize, and connect. There's plenty of food. Feel free to take some food home. The video will be on our YouTube channel, youtube.com/IDIPO within 48 hours. Right, Tim? So thanks for coming. We'll see you next time.